Hi, welcome to globalinvestorradio.com. This is the second in the series titled Ted Warren Investolator Part 2, The 4 Phases of the Stock Price Cycle. This was taken from Ted Warren's book, The 4 Phases of the Stock Price Cycle. The stock prices of every company fluctuate through a cycle consisting of 4 phases. The quiet, low-level period, called the base, can be termed the accumulation period. The rise is called the markup, and the top range is called distribution. The drop in price that follows is known as the markdown. And on this chart here, I'll just demonstrate to you some of those stages. Although I would say, to add to those stages, there is the random stock price action cycle where there is no one guiding the stock, or there's no one influencing it or sponsoring it. Of course, there's always market makers whenever we're dealing with listed stocks, but there's different levels of guidance. So I would say at certain points in the history of a particular stock that randomness takes over. And if you've read the book Fooled by Randomness or Black Swan, it's a similar type of concept. We can see patterns that reoccur, and sometimes they can be attributed to random action, and other times they can be attributed to guidance and sponsorship as well. And if you look where my mouse is, you'll see a nice accumulation action, and I'm going to show you a few mini cycles here, and it breaks up. This is the markup where my mouse is, and then the distribution and the markdown, and then you have the accumulation phase, the markup phase, where my mouse is, the distribution phase, and then the markdown, then the accumulation phase, then the markup, distribution, and a little bit of a markdown. Here we see the accumulation, the markup, and the distribution. This cycle here, from where my mouse is here to the point in 2008, is more of a regular cycle, whereas there are mini cycles during much larger cycles, and I just wanted to point those out to you. If we were looking at this from a larger cycle perspective, full-on accumulation here, the rise starts, the markup phase, and then an extra phase is the consolidation phase. Sometimes when a market's getting ready for a quite a substantial move, or they need to accumulate more stock, it will re-enter an accumulation type phase, which we call the consolidation type phase, and then it breaks out on the upside, the markup where my mouse is, and the continuation, the parabolic move, signifying that this move is soon to be exhausted, and the distribution, the price volatility, signaling distribution, and then we have the markdown phase. Now, where it hit this low point here at 10, we wouldn't have gone into this, we wouldn't have noticed there was no accumulation here. These are people that got caught out, that had accumulated here and got caught when the market came back down, and obviously they needed to distribute their stock and they couldn't do it at such low levels, but it's been pushed much higher. But what we can notice is when a market reaches its top phase, we start seeing parabolic spikes, and that usually signals distribution is around the corner. And as we see here with the distribution, and that would be the signal to sell into this market and to go short. And we see a nice markdown phase, and at some point in the near future a new cycle will begin and the accumulation phase will start. Okay, I'll be uploading part 3 either today or tomorrow. Stay with it, there's some more interesting concepts and ideas from Ted to come. Take care, over and out, bye.